Okay, so let's look at what's happening now. Today's like a pretty low volume day, and we have a lot of people repositioning for the end of the year. And it's interesting in investing. It's not a short thing, but a lot of times when we have an end of a year, it's a new beginning. So everyone on TV says, "Oh, Apple's up 5% this year." Apple, you forget about the year before, and everything starts basically from January 1st. So it's a good time for the stock market to brush off what's happening. And from what we're seeing, in our charts, it seems like the stock market is just following the Fed and the liquidity. So we don't know what's going to happen in January. Let's look at our meeting plan. We know that we have a Fed meeting on February 2nd. That's going to probably be the last time, if any, that rates are raised. And so from now until 3 months, we're just going to be in no man's land, maybe going down to flat until the Fed stops raising rates. We expected a Santa rally this week. That didn't really materialize. And right now, the primary issue with most people is we're still raising rates and reducing the amount of stimulus to the economy. All right, so let's see. Right now we have the stock market going down, and let me see. Okay, so we have people doing some tax loss selling and expect volatility in the last couple hours because people have to claim losses and do the last minute, last second portfolio manipulations. All right, so let's look at what we're expecting for this year. We're expecting recession. Recession, we don't know how deep it's going to be. So recession, that could mean basically the whole year could be sideways to down. We don't know, the effect of raising the interest rates on the economy, but we have to look for stocks that are fairly valued and stay away this year from stocks that are overvalued. So let's look at our game plan for this year. Let's look at the game plan. The game plan for this year. Rates might go higher a bit. High PE stocks, they will continue to drift towards a PEG of 1. We've been talking about Tesla for ages, how it's super overvalued. Its PEG ratio has been greater than 1 for quite a while, but it's only now coming back down to earth. So stocks like Tesla and Amazon will drift towards a PEG ratio of 1 in the new year. So we're trying to find PEG ratios right now under 1, and ones that are quality companies. We're looking for quality companies that are thrown out with the bathwater, that are reliable businesses that won't go down with the market. And that's the ones we want to concentrate on. The other things we're concentrating on are stocks with heavy demand, with steady demand, and that are needed by consumers, like staples, foods, alcohol, utilities, healthcare. The companies can raise their prices without an effect on their sales. Okay, that's the game plan. Let's look at the S&P. The S&P chart, we're still in a downtrend. Okay, can you still hear me?
No.
Can you hear me now?
Louder.
Can you hear me now?
Yes.
Okay, great. Sorry about that. Okay, so we're still in a downtrend. So we're making lower highs, lower lows until further notice. Until we break out of this, we won't break out of the downward channel until probably the Fed stops raising interest rates. So count on this lower highs, lower lows. There's a lot of smart people talking about this level right here as being the next level. So expect maybe in January to go back down in a straight line down to maybe here, and keep going down like this until the Fed's done. So until this is proven, otherwise, we're still on this channel. Let's look at some of our other notes here. Okay, other notes. One reason why the stock market's not doing so good this week is the rates of the 10-year and 2-year are up 2 to 4%. So that goes with our formula that's been pretty accurate almost every week since we've been tracking it. Every time the treasuries go up, the U.S. treasuries, the stock market goes down. So, and the Fed is still reducing its balance sheet, around $82 billion a month. So that in combination with the rates rising is most likely going to have the stock market going down. We had keep track of our market catalysts. Anything that changes, we're going to make a note of it. So the 2-year and 10-year went up. That's not good for the stock market. China ending lockdown is good. Right now they have a lot of infections, which is going to affect some of the output, maybe for Apple and other companies that are depending on China. But that was a good thing to happen. I expected a lot more positiveness based on what the rules they're making now. The market is currently still oversold. So those are all good things for the stock market, but I think that's being trumped by the treasuries going up. People are doing tax loss harvesting most likely today. That could be a reason for the market to go down. And okay, so we're doing some screens today on companies that can raise prices, have profits now, and will do well in this interest rate higher for longer environment. Okay, so the price of crude oil is unchanged. Okay, so that's usually indication of global demand for oil. So with China being up out of COVID lockdown, you'd expect oil to be in higher demand. So the higher demand commodity is, the higher the price goes. But we didn't see the price. We expected this price of oil to go up, partially due to that, but that didn't happen. And we know that as there's a recession, price of oil goes down because of a lack of demand. So those two things are basically canceling each other out, and we have no change in the price of oil. Dollar index is down another 1%. It's really good for the multinationals, so the more that goes down, the better the earnings are going to be for the multinational companies. Okay, so we already talked about this. Let's look at what sectors are doing good and bad today. I think what's happening, let's look at also the top performers. All right, so these are the top and worst performers in the S&P. Okay, the price of oil is up today, so that's why a lot of the oil stocks are up. And the top decliners, don't see any real common thread for these. Okay, so oil companies are doing real good today because of the price of oil going up a little bit. Let's look at NASDAQ. These are all high-flying companies with very high PE ratios. You'd think they would not do good. That might just be end-of-year tax loss selling. I'm not sure. Top decliners, high PE ratio stocks that have been crushed this year. Maybe it's because people are selling because of tax loss harvesting. Yeah, if you rank the worst stocks in the stock market this year, these are probably the ones. So people are selling at the last second for tax harvesting. And you see, look at the Dow, see what's doing the best. Banks and oil and healthcare. Okay, so that's a good theme for next year. Things that are going to continue to do good in a rising interest rates environment. So higher for longer means bad for tech. So let's look at Microsoft. We see a lot of tech companies in this top decliners. All right, so what we did this week, let's look at the top sectors. We know oil is going to be doing good. Change, energy, oil, all based on the price of oil going up. Home construction, okay. And the ones that are doing the worst, semiconductors and tech. All right, healthcare. All right, so that was a good little lesson learned. Let's go back to what we were planning to talk about. Yeah, so we're talking about the S&P. They say there's a lot of sayings that so goes the last week of the year, so goes to January. And that, we've had a down week so far this week, so people say that sometimes January goes down because of that, but it's all a wives' tales. But we're oversold right now. We've been oversold for quite a while. It doesn't mean we can't be oversold for longer. So it looks like in January we're going to be going down for the first couple weeks. And the DXY, we mentioned that the dollar is still going down, and it's still in a downtrend. And it seems like almost every commodity, every index that we're following has the same chart. So it looks like we're, either it has a channel going up, down, or sideways. So this one is going down right now, and that's good for our multinationals. Fear and greed, we're more fearful now than before. It used to be 40, now it's 35. As soon as it gets to extreme fear, that's the time when people are selling off, and that's the time to really start looking for babies thrown out with the bathwater. So we look at our emotional chart. We're not a capitulation really. We're probably fear right now. There's a very good indication with all this once in a lifetime Fed raising rates for the most of all time and the most liquidity taken away. They're withdrawing from the balance sheet, letting things roll off the balance sheets, the Fed. So all that could make us go into this capitulation phase, and that could happen in January, February, and you have to be ready for that and be able to look at stocks and make sure that they have a consistent business model that aren't going to be. Sometimes stocks go down, but the prices go down, but the actual value of the stock remains the same. All right, so that was good to look at that fear and greed index. We have a VIX around 22. Right now, that's basically complacency. That's the low end of the range. So the formula that's worked so far this year is whenever we get down to this lower VIX, it's time to sell, and whenever we get to the higher VIX, it's time to buy. So, this is basically the opposite of the S&P lately. So right now we're basically at complacency. We're not at fear or super panic level in the market yet. So I thought there was a couple of people that asked me after my last talk, what you're going so fast through these. I'm going through the same screen every time I look at a stock, whether it's a good one or not. And I thought it'd be good, like once a year, to review, how I see things as whether it's a good stock for a buy and hold or not. What I did was I tried to follow Warren Buffett's rules of valuing a stock and see if it's a good company or not. And I highlighted here the 8 rules to follow when looking for a good quality stock. And this is my best guess. If anyone has a better idea, let me know. But this is my best guess as to how to buy and hold a stock, find a good stock for buy and hold part of your portfolio. This is more a growth-oriented search. So I have a high free cash flow. This is pretty important because a lot of times, like right now, whenever the Fed raises interest rates, there are a lot of companies with debt, and the problem with debt is the higher the interest rates go, the more it costs to finance that debt and to refinance. So if you're looking at a balance sheet, like I gave a link right here. We're going to review like a United Health as an example of a stock that could do good in this environment because we have a health theme. We have people going to take care of their health regardless of price. You have a dividend. You have consistent growth, and it's a big company. So a lot of times when you have a lot of debt compared to the market cap, that's not good. So you have to watch each of these to make sure that they're consistently in line. Okay, so here are my formulas. High free cash flow. That means free cash flow is basically what's left over after all of your expenses from all of your sales. So, and what that does is that allows the company to grow, and it allows the company to reinvest and to give money back to the shareholders. So that's like super number one important. And a lot of times we look at these statistics, we see negative numbers, negative free cash flow, and whenever we see like a PEG ratio that doesn't exist, that's pretty sketchy. And we have to make sure that the company has money, especially in this environment, because big companies with a high free cash flow can take advantage of market swoons and buy companies, and whereas companies that are heavily indebted, they will have problems, and that will affect their earnings. Okay, the other things we need are annual earnings increasing in a straight line projected for many years to come. And we're looking for about 10% a year or higher. So we look at, this is from E-Trade, this is consensus earnings estimate chart. This is Peter Lynch's favorite chart. He likes it whenever a stock price goes down to here. This is the stock price right here. Whenever stock price goes down and the earnings are still going up, that's his best approach to buying a stock on sale. So you see, so that's what I mean when you divide the 2002 by 2003, you get the growth of earnings between the 2 years. So we want that to be at least greater than 10 for a stock that'll be a good performer over time. And okay, so the other things we need are a PEG ratio less than 1. So if we're buying a stock, a lot of times Warren Buffett buys stocks that have high PEG ratio because they have a high quality. Like he bought Procter & Gamble, Gillette at the time, and what the PEG ratio was really high, at like 3 or 4, but it was a quality business that returned, that was consistent earning over time. So sometimes you have to keep that in mind, how good the quality is for the company, for the PEG ratio. But a lot of times if it gets below 1, it means it's on sale. So if a PEG ratio is 0.5, that means it's half undervalued. So we like to look at the PEG ratio is less than 1. Return on equity, we'd like to have that greater than 10. And that basically measures how efficient the company is in making money with the money that they have. And the company has a competitive edge. So if the company has a monopoly or a large amount of people using their product, or that they have a unique product that no one else has, then that's a competitive edge. We'd like to see that because that makes that proves that there's no competition or little competition for what they're selling. Bonus is a dividend, so that adds to the total return of the stock. Half of all returns in the past 100 years have been from dividends, so that's why it's increasingly important. Highly transparent and predictable growth earnings streams, and that's something you don't see in charts. You just have to make sure it makes sense. Little or no debt. What that means, when we look at this Yahoo statistics, we want to make sure we look at total debt and then the balance sheet, total cash. So you subtract the total debt by the total cash, and you get what right now it's $6 billion total debt because you subtract the total debt from the total cash, and you compare that $6 billion of debt to the market cap. $6 billion out of $493 billion is not a lot of debt, so that is an acceptable range. Whenever you deal with banks, it's a totally different situation because they have a totally different out of whack way to show debt because part of their business is borrowing money and lending money. So it doesn't work for banks. Okay, so let's look at good management. Okay, that's something you can't find on a chart. You have to basically listen to the earnings calls and make sure that you're comfortable with whoever's running the company. Okay, so there we have it. We have these rules that I've been following, and coming up with anytime we review a stock, we look at those same measurements. So it's important to review this every now and then, just so you have an idea of what I'm talking about. Okay, so I just on this screen, this basically highlights all we're looking for. So we're looking for the market cap. The higher the market cap, probably the more reliable the company is over time, because they can withstand short-term problems in the market, and whereas smaller companies, they might not be able to adapt to a pandemic, for instance. For PE, we'd like to have the PE as low as possible, but if it's a quality company and it's consistent, we're willing to pay more for a company. So the PE ratio has to be low compared to the growth rate. So if the growth rate is 10 and the PE is 20, that means it's 2 times overvalued. And you can do that calculation by just saying what the growth rate is. We can see what PEG ratio it is by the growth rate divided by the PE. All right. And a profit margin is important. It tells you how efficient the company is, and we'd like to have over 10 there. And return on equity, we'd like to have greater than 12. So greater than 12 for profit margin, greater than 12 for return on equity. And we like to look at the dividend yield too. That adds to the total return of the stock. Any questions on that? Great. Okay, so there's a company called investors.com. They do the Investors Business Daily. They did a screen, and they did something very similar. They say this is like a Warren Buffett strategy, and that's basically what I just outlined, is a Warren Buffett strategy for investing in good companies. And this one is, it says it asks for the top 25% of all stocks in terms of 5-year annual EPS growth rate. So EPS growth rate is just basically, it's very similar to this. EPS growth rate is similar to the earnings estimates over years. So we look at forward projections this way, but this screen right here actually looks for that growth rate, the EPS growth rate, 15% earnings growth rate, sustainable, and 12% better 5-year average return on equity. So they're looking for growth rate, return on equity. They're kind of ignoring debt and a couple other issues that I was looking at. So the return on equity, they ranked it by return on equity. So they think return on equity is important. And so what I did was I highlighted some stocks here that I thought would work well in this environment. So the theme for this following year would be stocks that do good are stocks that have lower PEG ratios, perhaps that pay a dividend, that are conservative, that are in industries that are in high demand regardless of price. So some of those are like the drug companies. So I highlighted a couple of drug companies. Danaher, they do healthcare diagnostics. So they would spin blood around and give you a result, for one of their products. Or they give, and they sell kind of supplies. So that's an example of a company that that could do well, regardless of what the price of things are for inflation. We mentioned all the home builders. We were talking about these a couple months ago as possibly whenever the housing market is recovering, which is probably the end of next year when people get back to buying houses again, when interest rates are a little better. So this is like maybe next year, this will be recovering. So between Labcorp, this is an example of a company. They do drug testing for your blood, etc. So they have a duopoly with Quest, I think it's called, and so they do healthcare diagnostics. They were down a lot from the pandemic because people couldn't get non-essential blood work done, and so that could be why their stock is down recently. But that's an example of a consistent demand product outside of a pandemic. We know that Google is basically growing less this coming year than other years, but it'll recover at the end of next year. So let's say it's selling for like a market multiple now, which is on 18 PE, but it's on average growing around 14% a year. This year it's going to be, with a recession, it'll probably grow 3 or 5%. So that's not that great, but it'll snap back whenever the market gets back to normal times at the end of next year. Okay, so we met this D.R. Horton is a home builder, and it follows a similar theme of next year around December. It'll probably start recovering. Microsoft, it's in this scan. It basically doubled its free cash flow in the last 3 years. So it basically has a very diversified business model and steady demand even in a recessionary environment. And there was a guy talking about this on CNBC the other day. He was saying he's owned this since Bill Gates was running the company, and he's seen ups and downs in the market, but he sees a high diversification of their products and a steady demand even in bad times. And right now they're trying to grow in the cloud, and I just see it as a company. During a recessionary time, most growth stocks are going to be flat to negative. So you have to be, if you don't own any growth stocks, it's time to start nibbling at it, knowing at the end of next year things will be back to normal. That's called dollar costing into a position. So, that was a good little article there. Let's see. I tried to look at some of these companies that some of them are smaller in size, and they didn't have all the numbers that all the required information. But I did look at the company called Axon Enterprise. It's one of the lowest return on equity 5-year average. So it only has 12.9, and Sustainable growth, 16%, 17%. Okay, that looks pretty good. They make stun guns and video monitoring for police. So if you see one of those video cameras on the police person walking into a room, they manage those products. They give those away, but they charge for, it's like the razor blade. They give the product away, and they charge for accessing the video over time. So they have a big storage company. They're more of a tech company now because they're paying to access video over for storage. So if someone had to recall a video on someone, a police officer, they'd pay $20 a month per person for that service. So that's a recurring residual income, and that's why it's predictable. That's why they have a 17% growth rate there. I thought just for kicks, it'd be interesting to go over that stock just to see what the numbers are. It's a very small company, so there aren't that many analysts following it. We don't have many. It only goes out to 1 year, 2 years. So right now it's scheduled to grow at 25%. So they said 17%. So the PE is 63. So that's really, really expensive. And the PEG ratio is 2.3. If you think it's growing at 25%, and its PE is 63. So that's pretty expensive for this environment. We want a PEG ratio under 1 in this environment, because if we have a market crash, the PEG ratio of 2.3 will most likely go down to 1. Then the PEG ratios of 1 will hover around 1, or get just a little bit less expensive. But we have to be very careful in the next 6 months not to buy or get caught up in stocks with high PEG ratios. All right, let's look at the next little thing. We see that the forward P is 61. Wow, that's pretty expensive. The return on equity, 8.9. Profit margin, 9. Okay, and the PEG ratio, they didn't even figure that out, but we said it's around 2 or 3. 2. So it's not, this turned up pretty inconsistent, not pretty overvalued. And in this environment, it's pretty risky getting a PEG ratio of 2.3 stock. So we're going to pass on that one until we'll watch it go down to the PEG ratio of 1. Okay. So this is So right now we're in our emotional graph. We're still in fear. We haven't been in a capitulation, since the pandemic time. That's when everyone's selling, and there's a 99% capitulation. More stocks going down, 99% going down, and 1% going up. So you have to be ready for that, and you have to be right now, you can't borrow money, you can't put money on margin, you have to be very conservative, because every bank CEO is saying that we're going into a recession. Every smart guy that I've seen on TV is just saying, like Jeffrey Gundlach, he says there's a 70-80% chance of a recession, bad recession. So that means you got to be very conservative, in your outlook. You can't be expecting, you can't be over your skis. All right. Okay. So this actually, December didn't pan out. It's usually December's are usually up 1.1%. And this was the worst year for the Nasdaq or the S&P for, I think, all time. So right now, that just shows you the inconsistency of whenever the Fed's raising rates. All this is thrown out the window, because whenever the Fed raises rates, that just makes the stock market go down. So we can't even count on the first part of the year being good anymore. and that's why we have in our calendar, in our planning calendar, all yellows for the next couple months, because this is recessionary time, and 3 months before the end of the recession, that's whenever the stock market goes up. But there are some people saying that the recession could last until the end of this coming year. So in that circumstance, we have October as a time when we start getting green. So, okay, so don't be overextended. Make sure that you don't buy the high-flying stocks. Stocks in our market movers, the S&P, let's look at those high-flying stocks to avoid. Every one of these is super high PE ratio, and even if they're down 70%, it's not where they come from. It's their PEG ratio, how much their debt is, and the more the stocks with a higher debt ratio, a higher amount of debt in the higher PE ratios are going to struggle, even if they're already down 70%. The stocks that are going to be doing consistently in this environment are the ones that are paying a dividend. Let's see which ones are paying dividend here. The oil companies are paying dividends. And drug stocks. Okay. So we have like a repeat of last year's situation where the conservative stocks are, we're going to do at least not as bad as the flying stocks. But does that mean that you should sell all of your growth stocks? Well, if we don't know when the stock market's going to turn and start, going up and out of this downturn. So you have to, for me, I've held Apple through two recessions already, so I don't have a problem holding it now. I think you just have to be very conservative right now in what you're doing, and don't borrow money, and make sure that if you have any really expensive stocks with high PE ratios or high PEG ratios, that you scale back on those, because the first couple months of the year, I think consensus is going to be kind of nasty. Does anyone have any comments about what you think is going to happen in the next year?
Not really.
Not really. Okay. All right. So this is really tough. But the great thing about January 1st, everything, it's like a magic. Everything that's said on TV is, this stock is up something year to date. This stock is whatever year to date. So all this the S&P is up 5% year to date. So it all basically changes on January 1st for an investor. So it'll be great to not see 40% down, year to date, when you're looking at the TV. But I mean, in reality, we're still going to be draining money from the economy for the first couple months, and that's going to make stock prices go down. And it isn't until everything goes back to normal with the Fed, and they say, let's say February 1st, they say we're done raising rates, but they're going to hold the rates steady for like a long time. So that's going to clamp down the whole stock market from going up. And I don't know. I think it's safe to hold stocks that are going to do well regardless, of this short time. I think stocks, you have to realize that stocks are going to go sideways or down a little bit for a couple months. And if you're not invested at all in things, you have to look at when stocks are going to recover. So we have December to January of the next year. The Fed might be reducing rates. We don't know that, but if we're looking at investing in home builders, that could be a target date. We think that they could be starting to go up. And with every stock that you're watching, you have to see what's the catalyst for it to start going up. And it seems like a recession could last from half a year to a year, and 3 months before the end of the year, everything pretty much starts going back to normal. So let me see. Let's see what else we had. Let's see what else is happening here. Okay, let's look at. We haven't looked at stochastics in a long time. All right, let's look at almost every index we're following is in a downtrend. You can see we're at lows and stochastics for almost every stock and every index we're following. Every stock is making lower highs, lower lows, every index, almost every stock. Let's look at QQQs. That's tech, technology. We have consumer discretionary. It seems like until this interest rate issue is taken care of, like in February, we're still going to follow these same patterns. Healthcare is going to continue to be paying a dividend, not going down. So if you look at these charts are going to pretty much continue. The XLI will continue to be going sideways. And okay, yeah. So you can see that the dividend paying indexes are going sideways, and they'll probably continue to go sideways. So let's look at the stocks right now. The drug stocks are truly in an uptrend. They're starting. I think they're the new momentum trade. I think. I'm not sure exactly if oil is going to stop going up, but let's look at energy ETF. It's going sideways right now. It used to be in an uptrend, but now it's pretty much range bound, and it's being replaced by. Let's look at the healthcare. We do have a little bit of a temporary higher highs, higher lows in this. If it breaks out of this, and goes up to here, then the healthcare is the new leader of the stock market. We don't know. Let's look at some of these individual stocks. AbbVie, and we have Abbott starting to go into that uptrend. We have Alibaba. We have every tech stock is still in a downtrend. Dividend stocks pretty much sideways right now. And Amazon, tech stock going down. Apple, same thing. So it's lower end of its downward trend. AT&T, dividend stock, is going sideways. So I think what we're going to have for the next year is these, at least for the first half of the year, it's going to be sideways. Every chart that you see here, if we look at it 6 months from now, it'll probably be the same. Same trajectory, sideways, up or down. So you have to understand that whenever you're positioning for the next year. Bristol Myers, sideways, not up. Colgate, sideways dividend stock. CSX going down. It's a cyclical. It goes down with the economy, up with the economy. JP Morgan starting to turn sideways from a downtrend. And Microsoft still going down with the stock market. PepsiCo it has pricing power, and it pays dividend, and it is still in an uptrend. I guess if you have a stock market sell-off in January, you'll see this back down to here. That will be a good time to buy it because it's still in its uptrend. If it breaks below that, then that beautiful pattern's done. But until then, we still have an uptrend in Pepsi. And Procter & Gamble is consistent. They sell a consistent amount of things, even in good times and bad, and they can raise the prices. And they're sideways. So let's look at these patterns and watch them for at least the next 6 months. They probably stay the same. Verizon, is going down. I think their stock price will go down regardless of this stock market because they're losing market share in a major way. Let's watch their dividend. I have a new bold prediction for this year. I think Verizon will reduce its dividend if their stock price keeps going down. Visa. Even in inflationary times, people spend more money on goods that are higher priced. So it averages out for Visa because they're a toll collector. So even if the prices are higher, they make less sales, but it equals the same amount of volume total. So that's why Visa will still have consistent earnings over time. So it looks like it's sideways, and MasterCard is the same way. Waste management, they have a monopoly. So we like monopolies in this environment because they can charge steadily more for their services. And they're still on an uptrend. And CVS, it's like a dividend paying, so it's going sideways. And Johnson & Johnson, dividend payer. It is possibly going in an uptrend, higher highs, higher lows, but you can also argue that it's been trading in this range for a year now. All right, Walmart, dividend-paying stock, very consistent earnings over time, and they do well in a recessionary environment because they have people trade down. They'll go down. They'll not shop at Macy's and they'll buy their stuff at Walmart instead. So Tractor Supply is a winner. I'm not sure exactly why. I'll have to ask Matthew next time he's attending. But it's making higher highs, higher lows. You'd think that Tractor Supply, they sell corn feed or whatever it is to farmers and local supply store for farms. But they're in an uptrend. Not sure why, but that pattern will probably continue in the future, in the next half year at least. Berkshire Hathaway, they're a financial company. They're heavily invested in tech, Apple. So, but they have a very diversified model that they're probably affected in a major way because they're heavily levered to the American economy. So you'd figure that let's see. It's been going sideways, so they'll probably continue to go sideways. MasterCard, same chart as Visa. They're basically sideways. They're not going to be affected a whole lot by the pandemic, or by the recession, and they pay a dividend. eBay is in a downtrend with the tech stocks, and Boeing is pretty much, it's like a dividend stock. It's pretty much in this trading range for the last year, so probably continue that. And Tesla, it is still at a price of 123, still overvalued. It's down 70% this year. So it very well could go down. You divide 129 by 1.5, which is this PEG ratio, and it's probably going to go down to that in a bad market. NVIDIA is trying to make an uptrend, but it's still in a downtrend with the market. In Nike, it is breaking out. It seems as though it broke out of this long-term downtrend, which is for a whole year, but only recently, with a good earnings report, it started going up. So this is following a pattern that Starbucks and companies like the drug stocks are starting to break out of their downtrend. But they have a lot of direct-to-consumer sales that are helping it improve its margins. Ford is still in the downtrend. You can see that it's making lower highs, lower lows, and the next stop for Ford is probably down there. And Upstart is an example of a stock that we followed it since the beginning of last year, and we mentioned there were a lot of numbers that weren't available at the time, And whenever you have a stock, if you buy it and the stock runs up on you, it's pretty important to take some of those profits if the fundamentals don't follow. So if the PEG ratio ends up being a 5 after you bought it at a PEG ratio of 1, you have to take some off the plate as it goes up, because if it doesn't really have a whole lot of numbers to back up the price appreciation. So we're just following this, and it's going down more. It's down to 12. Wow. Used to be 100. So this is Pfizer. They're in a trading range, probably between 90 and 100. So all these patterns, I bet you, 6 months from now, we're going to have the same patterns. Costco, they're at the bottom of their long-term trading range here. The interesting thing about Costco, if they raise their price for their membership, that could be a catalyst for them to go up to here. We don't know what's going to happen, but they're heavily affected by the economy. The people don't spend as much because of the economy or a recession. Then this will be greatly affected. Okay, T-Mobile continues to be the best performing stock we're following, and it's at the bottom of its range, and they're taking market share away from every other carrier, and they're offering a new internet service. So they have a lot of catalysts that can make this continue to go up in the next year. So next stop for this is up here. All right, so that is it. I think I have maxed out my time for this presentation. I hope you have a great new year, and if you have any questions for me, I'd be glad to answer them. Do you have any questions?
Not right now.
No, not right now. Okay, great. Excellent. Well, thanks for attending, and have a great new year.
Yeah, you too. Happy New Year.
All right, thanks.